following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Nick in Tampa. Hey, Nick, what's going on?
Tom O'Brien, it is an absolute pleasure.
Thanks so much, man. We appreciate you calling.
No problem. Dude, I've been listening to your show for about 2 years now, and it has just been wonderful. I listen to you, Basil, Andy. You guys do an amazing job.
Well, thank you so much. We appreciate you growling and prowling out here with us.
Now, Tom O'Brien.
Well, good afternoon, everyone. This is Andy Heck filling in for Tom O'Brien. I got to try the tiger roar. And welcome to the Tom O'Brien Show with me, Andy Heck, filling in, coming to you for the next 2 hours today. We're going to do 1 hour of the Tom O'Brien Show, which will be followed by a episode of the Commodities Hour with me, Andy Heck, 1 hour earlier today. So let's take a look at what's going on in the markets. It's down day in equities. We have the Dow Jones Industrial Average down about 117.5 points at 21,360.68. The S&P 500 is slipping about 18, about 2414.37. And the NASDAQ, well, that's down about 47 points, 6104.16 at the moment. The gold is up 230, which is not a big move for gold, considering that the September dollar index is down 484 points. So we got a weak dollar, and gold is really not bouncing much away from these critical support area. Silver is still under $16. We've moved under 16 for the first time in 2017 over recent sessions. We are at 1598.50. Platinum's up about $2.20 the ounce. Palladium down 430. So the markets are on their own, really. We have light sweet crude oil up 21 cents a barrel. It was up a lot more today. It was actually over $1 higher at one point, as the both the American Petroleum Institute and the Energy Information Administration surprised markets with larger than expected withdrawals from inventories. But crude oil is up 21 cents, but it is way off the highs. We're at 45.33 on the August contract, and we were as high as 46.53 short couple of hours ago. So that's what's going on over there in market land, and I'll keep you updated throughout the hours. Basically, the world is providing bullish and bearish influences on all of these markets, with U.S. stocks down today and the G20 kicking off their meeting in Germany. Lots of demonstrations outside the hall in Hamburg. I don't know if any of you have ever been to Hamburg. It's a wonderful city in Germany, very interesting city. But it seems that a lot of demonstrators have descended upon the city for the G20 meeting, which will commence, I think, later today. Tomorrow, the President of the United States, Donald Trump, will be meeting for the first time with Vladimir Putin, the Premier of Russia. That'll be interesting, considering all of the things going on in the world. The president of China is there, and North Korea is likely to be a big topic of conversation, as they celebrated the July 4th holiday by firing an intercontinental ballistic missile test, and the rhetoric continues to go higher. But even though stocks are down today, folks, they really have been ignoring all of the influences coming from that Asian country and the rhetoric that's going back and forth between the U.S. and North Korea, and the U.S.'s problems with China not being able to rein them in. So basically, as Mike Kay said, they called it a gift package for the United States, that missile. That missile, some experts say, could reach the United States, could reach Alaska. And if they could reach Alaska now in a couple of short months, they might be able to reach Los Angeles, other coastal cities, and maybe even into the mainland of the continental 48. So there's lots of uncertainty ahead, certainly in markets, but the markets are not really looking at that. Actually, what the markets are looking at is what central banks are doing these days. And Mario Draghi, the president of the European Central Bank, has started to make noises in recent statements that are much more hawkish than they have been in the past. And he's starting to indicate or getting markets used to the fact that we might see an end to quantitative easing in Europe. The program is supposed to end at the end of this year, but we might be getting a statement out of Draghi about tapering that quantitative easing program. And I want to remind you all that the dollar index was trading at 78.93 in May of 2014, when our U.S. Federal Reserve started talking about tapering the quantitative easing program here, and said that they would start raising interest rates when appropriate. Now, we're hearing similar messages out of Draghi right now. And if you remember, in May 2014, the dollar blasted off. And in a 10-month period, it rallied 27% from the lows, from under 79 all the way up to 100 on the dollar index. Now, the euro is trading at around 114.65, around that level. And that's up significantly from the 103 level that we saw in January, when the dollar was on its highest level since 2002. Right now, when that tapering announcement happens, we could see a blast off in the euro, which would depress the dollar index. And the next level of support there is down at the 91.88 level on the September contract. And folks, that would be a big move. And if we were to go through that level and we had a move like we had in the dollar from 2014 in May to 2015 in March in the euro, where the euro was to blast up to, the 120 level or higher, we could put a lot of pressure on the dollar, which would have important ramifications for many markets. Now, let's think about that for a moment. We have the U.S. administration that is really in favor of a lower dollar here. No question about it. I mean, it will stimulate trade. No question. It will lower the trade deficit in the United States. And that is what they're looking for, a more level playing field when it comes to trade. But it will also raise the prices of commodities. We have not really seen it yet. The most dollar-sensitive commodity, gold, with the dollar now just, trading down at 95.575. If we remember the lows, the area of support now is around 95.225 or something like that, last week's lows. The gold is really not responding to the lower dollar right now. So the dollar is going to be very important. And if we go through and start heading down towards 91.88, it's going to have very important ramifications for these commodity markets. Now, when we get back from the break, we're going to talk a little bit about oil, because oil's very interesting over the last week or so. And that's certainly going to affect all markets. So stay right there. And remember, give me a call. The number is 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Trading is different than investing, but the opportunity to take advantage of short-term trends is only one if you get the direction right. Direction leveraged and inverse ETFs offer bold trades on U.S. and international stocks and bonds. Direction leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back to the Tom O'Brien Show. This is Andy Heck, filling in for the vacationing Tom O'Brien. We have the Dow Jones Industrial Average down 117.5. The S&P 500 down about 18. The NASDAQ is down about 47 points, according to my latest screen here. And I know we said we were going to talk about oil this segment. We'll push that to next segment because we have John from Philly on the line, and we always love talking to John from Philly. How you doing, buddy?
Hey, Andy, thanks for taking the call. How's Las Vegas today?
It's good. A little bit cooler, probably 107.
Oh, well, lovely.
I love it.
Andy,
So you want to talk about gold, huh?
Yeah, I wanted to ask you a question. Draw upon your experience back being formerly an institutional gold trader, both in the physical metal and the COMEX. And first, an observation. Going back now over the past 3 years, not implied volatility of gold options, but historical volatility in COMEX gold now has come down to multi-year lows. In other words, there's just very little action in it. You know, you get a rally of $100 and it comes back 50. But historical volatility now is running very, very, very low, which is unusual. Number two, we're right here, middle of the year, and prior to the bull market top in 2011, gold had a fairly regular seasonal tendency to sell off May, June, bottom 1st of July, and then rally. And as you look at the charts, we're all seeing the same thing, but drawing on that experience that you've had in the past, is there anything that you can share looking out the next 2 months that would lead you to think buyers will come in for this futures contract in that next 2 months?
Let me handle that one issue at a time, 1 point at a time. Let me first talk about historical volatility coming down from past years. I think that there's so many ETF and ETN products out there now. that have added liquidity to the gold market compared to back in the 80s and the 90s when, I was trading on the desk and buying and selling big quantities of gold all the time. And we saw a lot more volatility on a percentage basis. We still see $20 moves. We saw $20 moves back then, but $20 moves today on a percentage basis are like 1/3 of what they were back in the 80s and 90s when the price was trapped in a range between $300 and $400. So you're quite right about historical volatility coming down dramatically. But I think that we've also seen a tremendous more amount of liquidity added to the market with ETF and ETN products, which drives into gold, which brings more buyers and sellers into the market, which has smoothed it out over time. That's kind of how I read that one, John.
Okay.
As far as seasonality is concerned, I think that given the current situation in the world, you have to throw seasonality out the window for the next 2 months. Now, gold, Tom has been great about pointing out how the relationship between gold and the yen. And it's been really good relationship for a while. And as the yen rallies, it seems that gold rallies. And as the yen comes off, it seems that gold comes off. And the reason that the yen is coming off now, in my opinion, is because, they got some big guns pointed in their direction coming from our friend over there in North Korea. And I think that's depressing the Japanese yen and Japanese markets to some extent. And, it could be the thing that's depressing gold that really ignites it in the weeks ahead, because this is a very tough issue that does not have an easy solution. I do not see North Korea backing down, and I do not see the president backing down. So, I'm particularly worried about this situation, and this could cause, this is why I think gold is a scale down buy here. Even if we break, below the 1217 level, even if we go back and take a brief look below 1200, I still think that gold is looking very interesting here. No question about it. So that's how I see it. I don't see a lot of seasonality this year in gold. So I think that world events are going to drive gold in the coming weeks. I think gold, John, is still suffering from that selling that was done on the 26th, a week ago Monday, in London. I think that was, it takes a while to filter, 1.8 million ounces through the market. It's like a hot potato. So,
tell me, when you have big blocks like that go off at illiquid times, do the high-frequency algorithmic trading systems, do they account for that and maybe factor in buying or selling aggressiveness? Do you know?
I think they do. I think there's a lot written into the formulas when markets become, particularly, maybe not so much in the financial markets, but in the commodities markets where, commodities can double or halve very quickly, very short periods of time when there's a news flash or a large chunk of selling or buying that comes into the market or a weather-related issue. I think that they have circuit breakers, a lot of them, and I think that the high-frequency traders kind of stepped aside. I look at what happened because of the lack of news as an order to sell that was mishandled, that was not done well. Whether it was manipulative or not, I have no idea. That's up to the CFTC to come to the bottom of that. But, since we haven't heard anything about, a fat finger or a mistake or anything like that, I think that was a real selling order. And I think that the high-frequency traders do get out of the way. A lot of these high-frequency traders, while they'll never tell you this, I think what they do is they try to run stops on both sides of the market in these markets. And they're very successful at doing it.
Yeah. Thanks on that. One last question, if you could. April 17th, gold contract topped out at $12.97. In May, we came down to $12.15. In June, we got up to $12.98, and now we got down to $12.16. Just that pattern alone, exact highs, exact lows, does that lure you into becoming an aggressive buyer
I am a scale down buyer here. I like to buy gold on weakness here. I think it's the geopolitical landscape that's going to be supportive of gold. I'd love to see silver do a little bit better, but as long as silver stays above 1570, I think it's okay. So I am a buyer of gold here. I do like it. I think we might look back in a couple of weeks and say, wow, gold and silver were really on sale there. And, markets look terrible when they're going down. They look so good when they're close to the highs. And that's what we're seeing in oil, John. I mean, how bad did oil look at 42.05, right? And how great did it look when it was 52 bucks? And that's, that's kind of that's what we have to fight in terms of, our trading heads, not to get sucked in. When you listen to TV, when you watch pundits, I mean, we're better on Tiger TV, I think, than the rest. But when you watch these pundits, a lot of times, they're calling for the 30 handle when oil's 42, and then they're calling for 60 when it's up at 52.
Thanks so much for the input, Andy.
My pleasure. Have a great day, John. When we get back, we'll continue. We'll talk about oil. And I want to talk a little bit about backwardation and contango and ETFs. So stay right there.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. This is Andy Heck filling in for the vacationing Tom O'Brien. Hope he's having a great vacation, well-deserved vacation at that. The Dow Jones Industrial Average, well, it's moving a little bit lower into the close. We're down 138.5 points there. The S&P 500's approaching down 20 on the day, and the NASDAQ, well, that's down 53.5 points. Gold's up only $1.80, but the dollar index settled down 484 points here. And Mike K is asking me my thoughts on accumulating platinum down here. I like it. I think you buy it. I think that you buy it and you leave plenty of room to buy lower. I think in all these markets you have to leave room right now in the precious metals because, you know, there's always a chance of kind of a sharp sell-off here, a blow-off bottom. But I think the geopolitical landscape does support that whole precious metals sector. So during Dave White's show today, he was talking a little bit about leveraged gold ETFs not moving with the metal. And I just wanted to point out that this is a problem that's inherent in many commodity ETF and ETN products. And the reason for that problem is market structure. There are two market structures when it comes to the forward curve in commodities: contango and backwardation. Contango is when forward prices are progressively higher than nearby prices. And when people have to roll, when traders, longs, have to roll their positions, they basically have to sell at the lower price, buy back at the higher price, and they pay the contango. It's a premium for the forward. Now, contango usually represents an equilibrium market, one where supply and demand are in balance, or a market that's in oversupply, because the higher prices in the future assume that producers, because there's so many supplies, will cut back on their supplies and that prices will move higher in the future. That's kind of the theory behind contango. Backwardation is where the forward prices, the deferred prices, are lower than the nearby prices. And it's a sign of tightness in the market. The reason that even though the market is tight, the market structure shows that the deferred prices are lower is because they feel that the market is telling us, the forward curve is telling us that producers will respond to higher nearby prices by increasing production, and that inventories will grow, and that will put price pressure on the futures, on the deferred contracts. So when it comes to these commodity ETFs, in something like gold, which tends to always be in contango, because there's always plenty of above ground stocks of gold. Remember, central banks around the world hold 30%, over 30% of all the gold ever mined in the history of the world. So this market is in contango. So when you buy these ETFs, the longer you hold them, the more the contango eats away at their value. And when gold volatility is low, just like John was pointing out in the last segment, because of all the additional liquidity and volume that's come into the gold market over the past decade or so, basically, if gold is not moving over a lot, and if you don't catch it and your timing isn't perfect, contango can eat away at a lot of those types of structures. So that's the quick and dirty on contango and backwardation. You have to be careful with the leveraged ETFs because they are particularly sensitive to the forward curve. Now, if you're long something that's in backwardation, hey, it pays you to be in there and wait. But if you're long something in contango, there's a cost. There's a premium, and there is a cost to it. So let's turn our attention right now, just for a couple of minutes, over to the oil market. And I want to talk a little bit about what's going on in the world of oil. I basically believe that $50 is the sweet spot for crude oil. It's the price that's half the price of June 2014, when it was trading at $107 a barrel. And the bottom line there is it's a price that makes consumers, that satisfies consumers. Of course, they'd rather see it back at $26, but $50 is a livable price. Gasoline prices are under control. They're way under $2 per gallon wholesale, around $2.30 on the retail. When it comes to producers, it's double the price it was on February 11, 2016, when it traded down to $26.05. So It's a price that satisfies them. And with the Aramco IPO coming up in 2018, it's a price that OPEC can live with. It's also a price where U.S. production is economic. So $50 per barrel is a sweet spot price for crude oil. Now, we were pushed down to $42.05 on June 21st on a confluence of events in the crude oil market. First of all, the market wanted OPEC to come out and cut production more. They didn't do it, so they sold oil on that. Then the Qatar blockade by the Saudis, by the Egyptians, by the UAE and Bahrain and other allied nations, because Qatar was getting too close to Iran and supposedly funding terrorist organizations in the region, and probably more importantly, because Al Jazeera broadcasts out of Doha, Qatar, and they are big critics of the Saudi royal family. Well, they blockaded on air, land, and sea, and they basically pushed the Qataris into a corner. Now, oil went lower on that, even though the temperature rose in the Middle East. And why did that happen? Well, the market perceived the potential for the rift within OPEC to even widen, and that could mean additional cheating. And as the price came down, there's more reason to cheat and sell more oil. Just remember, these countries depend on the oil revenues for their cash flow. So the lower oil means you got to sell more to get the same cash in, and that was the fear. Now, the oil market tends to get very bearish on lows, very bullish on highs. I think we've seen two very good signs for oil to go back towards the $50 per barrel. Three, actually. The first one, crack spreads. Crack spreads. Let's put up a gasoline crack spread in the den for you to take a look at here so you can see what I'm looking at. Basically, over the last, on the daily chart, they have rallied from under $15 to over $18 per barrel. Now, seasonally, this is a seasonal time of strength for gasoline. In the heating oil, where it's not a seasonal time of strength, that's rallied from under $14 to over $16. So that is supportive. It shows demand for crude oil at these lower prices. So that's the first reason that I think crude oil is supported here. The second reason is that we saw the first decrease in rig counts from Baker Hughes last week. It was only 2 rigs, but it shows that U.S. production is sensitive to the lower price of oil. And finally, the numbers out of the API and the EIA this week blew away market expectations. You had a 5.76 million barrel draw and a draw in gasoline, 5.7 million from the API. Today, the EIA came out and said they dropped by even more, 6.3 million barrels of crude oil. The gasoline was a little less, but still a big draw, 3.7 million barrels. And they even had a draw on the distillates, 1.9 million barrels. So these crude oil did pop up. It did pop up to 46.53. It is coming back down to 45.30 here. I think that crude oil is going to head back up, but more than crude oil recovering, I think the XLE is going to recover, because the XLE has really had a problem since December. I think the XLE is looking right now pretty good. When we get back from the break, we're going to talk about stocks a little bit. I want to talk about the stock market. So stay right there. We'll be back.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com.
With over $56 million in cash and over $66 million in working capital, Great Panther Silver is positioned as a company with a solid foundation and poised for growth. While completely unhedged to the price of silver, Great Panther retains 100% ownership in 2 producing mines in Mexico, which is the top silver producing country in the world, along with future potential production in Peru. Great Panther is highly leveraged to the price of silver, and after a great year of performance in 2016, Great Panther Silver has a strong outlook for 2017 as well. With good liquidity in trading and strong fundamentals on the balance sheet, while remaining completely unhedged to the price of gold and silver, now is a perfect time to take a closer look at this equity. If you'd like to find out more about Great Panther Silver, then go to greatpanther.com or check them out on the NYSE market, symbol GPL, or the TSX, symbol GPR. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Tom O'Brien.
Andy Hecht sitting in for the vacationing Tom O'Brien today. Hope he's having a great time wherever he is. I'm covering from him here from sunny Las Vegas, where the temperature is probably about 108 degrees or so. So I'm happy to be cool and in the house. And the Dow Jones Industrial Average, well, it's heating up there, down 150 points plus. The S&P 500 is down about 19 or 20 points. The Nasdaq's down 63 points. That's been the weakest index, and that is picking up some downside steam going into the close, which is in about 18 minutes from now. So we're in the third quarter. It's hard to believe, folks, that time just goes so quickly in these, it just, the older I get, the faster it goes. But I'm going to be like Tom. I'm going to start counting backwards from this age. And, it's all a matter of mindset. So I want to talk a little bit about stocks. But first, just on the oil, I want to caution. Commodity, one thing I learned as a commodities trader is that the bullish sentiment tends to peak on the highs. It tends to peak, the bearish sentiment peaks on the lows. And on June 21st, when oil got down to $42 a barrel, I can't even count on all my hands and all my toes how many analysts I heard saying, oh, $40 next stop. Oh, we're going to see a 30 handle. And then, they, of course, roll out some people who basically say that crude oil is going the way of whale oil. And hey, while that might happen in the next 20 or 30 years, given all of this new energy available to us because of technology in the world, the Elon Musks and all of the world, you know what? We're really not concerned with that. We're interested in where oil's going to go tomorrow or next week or next month or maybe by the end of the year. But we're really not interested in where it's going over the next 20 years. I mean, I don't have a crystal ball for that. So, hey, that I don't focus on. But what I do focus on is sentiment. And sentiment gets too extreme when prices go too extreme. So always keep that in mind. Always take a step back and take a look at these markets rationally and think if it's just a little, if the analysts are just a little bit too happy or just a little bit too afraid. Fear and greed, that's what drives markets, folks, and also it's what reverses them. So let's talk about stocks here, because stocks are really interesting. And we got to start our conversation on the stocks with a conversation about bonds. And I started the show off by talking about how Mario Draghi is going to probably taper the QE program there in Europe soon. And that means that interest rates will start to rise from negative 40 basis points. And we've already started that here in the United States 3 years ago, and we're deep into interest rate hikes. And right now, the U.S. 30-year bond has been falling like a stone. Today, it's down another 31 points at 152 and 12/30 seconds. And we're going to have lots of supply coming into the market as the Fed lets $50 billion of their balance sheet roll off each month, and that's going to come to the market to be funded, and that is going to put pressure on bond prices, and that means higher interest rates here in the U.S. and in Europe eventually. And higher interest rates are not good for stocks. But hold on a minute. Because the stock market has something that other markets do not these days. Maybe some commodities, because, there is natural buying in commodities. Every time you get in your car and you turn the key over and you press the button with the electronic ignitions these days, and you're consuming crude oil, unless, of course, you're driving a Tesla. You're consuming gasoline, which is crude oil. Every time you power your house, you're consuming natural gas or electricity, coal, whatever it is. You are consuming those commodities. In the stock market, you have the advent of the IRA and the 401k that has provided buying in the stock market every single day. And that is a very new, we look back 30 years ago, that didn't exist. People are saving for their retirements. They've been trained to save. And where else do they go with their money? They go to the stock market. The more sophisticated investors, like here on the listeners here on TFNN, they go out and they do their homework and they pick individual equities. However, the vast majority just put their money into these big mutual funds, which look at the indexes, which buy the stocks on the indexes, and there is natural buying in the market each day. Now, there is not natural selling in the market each day. Even though the population is aging a bit, there is not that natural selling that there is. And then there's dividend reinvestment, which creates even more buying. So if nothing is happening in stocks, the path of least resistance is higher. And that's why the CAPE ratio is up at 29.75 times earnings, and average PEs are, they're at the third highest level in history. If you look at the CAPE ratio, there's only 2 times in history when the S&P 500 had a higher multiple, back before the crash of 1929, the Great Depression, leading into the Great Depression. And the second time was in the tech bubble in the late 1990s. Those are the only 2 times that multiples have been higher on stocks on average. But we have natural buyers in the market. And unless there's fear, real fear, and real uncertainty that translates down into selling in the markets and going to cash or going to gold, you're going to continue to have this upward bias in stocks. And, that's why every dip has been a buy. We've been trained. I'm 57 years old. I have been trained over the course of my lifetime that stocks on every dip are a buy. And I'm not alone. There's another several hundred million people in the United States who know that if you bought on every dip since 1980, you've made a lot of money in the stock market. So that's kind of a lesson. It's something we have to remember about the flow of funds. Now, the last time we had a significant sell-off in the stock market was in the beginning of 2016. The S&P 500 dipped by 11.5% over a 6-week period. But then, and let's see if I could find it right here on this chart, if I could put it up there. But then by April, February 26th, February 11th, we reached the lows. By the middle of April, we had made back all of those losses, and we have taken off to the moon since then. Now, we're having a little bit of a dip today. Right now, in the markets, we have, let's just take a look at where these are trading. I have to look at it on my cell phone here, since I have my screens all on TFNN. We're down on the S&P 21 points. We're down on the Dow 167. We're down on the NASDAQ 67. But you know what, folks? The chances are that buying is going to come into these markets because this is just how we have been trained. Now, I'm not bullish on the stock market. These valuations are not rational to me, but rationality and logic are not always in force in markets. So I just wanted to take some time to talk a little bit about kind of my theory of how this stock market's going and why there's so much money flooding into it. Keep your eye on those bonds, because when fixed income products start offering attractive yields, money will eventually flow over there, and then we will have the real correction in equity prices. But we're not at that point yet. Watch the words of Draghi. It could be coming in the weeks or months ahead. When we get back from the break, we're going to kind of sum up Tom's show and do a little bit of a lead-in to the commodities hour, which starts at the top of the hour. Stay right there.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Welcome back, folks. Andy Hecht here, sitting in for the vacationing Tom O'Brien. And I just want to remind you that I will be back at the top of the hour at, 1 p.m. Pacific time, 4 p.m. Eastern Standard Time, with a recap on the commodities hour of the Q2 action in all of the commodities, all 6 sectors. I'm going to go through what happened in Q2, what's happened so far in 2017, and what I think, where we stand and what my view is going forward into Q3. So I'll give you some ideas for that. So stay tuned. Don't go anywhere. After Tom's show ends in about about 6 minutes. I will be back with you after a brief break to focus in on that commodities sector. Meanwhile, the selling continues. It looks like we're going to close kind of close to the lows. Dow Jones is down about 156. The S&P 500 down 23. So that's picked up some speed on the downside. And the NASDAQ down over 60 points here. Gold is up $2.80. Silver's up 9 cents. But that is a very weak performance considering that the dollar index did settle down 484 points at 95.575 today. So I guess the takeaway from today's edition of the Tom O'Brien Show is to be careful with market sentiment because it tends to get too bearish on the lows and too bullish on the highs. And we see that in markets like oil. We see that in markets in commodities all the time. We see that in individual stocks. In the indexes, as I said before, the bottom line is you got to wait for those bonds to turn. That's when the stock market is going to really turn. When Europe decides that interest rates are going up and the U.S. continues to pare down their balance sheet and the bond market starts to really fall and interest rates go up, that's the competition that stocks need to draw the capital. The capital that flows in every day as people save for big ticket items, for their children's college, for cars, for homes, and for their retirement. That's the big one. So as money, capital will flow from stocks to bonds, and that will slow down the ascent of these stock markets that have been rallying. You know, the latest leg up is from the beginning of 2016. But if I go to a quarterly chart here of the S&P 500, you'll see what I mean. It's a steep slope, folks. It's a steep slope, and it's going to be very difficult for companies to keep up with earnings to justify the current level of multiple, which is the third highest in history. So that's basically it for today. Keep your eyes on Mario Draghi. Gold market, as far as that's concerned, I think it's a raging buy down here. I think you scale down buy. You leave some room for a potential blow off to the downside. But I think that in a couple of months, you'll look back at the price of gold and you'll say, wow, what a bargain gold and silver and even platinum were back in the beginning of the third quarter. As far as oil's concerned, I'm not looking for much. I'm looking for a range between maybe $42 and $52 a barrel. I think we're towards the bottom end of the range. I think that we're going to drift a little bit higher. But I do think that there's some potential in the XLE, which has been crushed and could come steaming back if oil starts to stabilize. I love the crack spreads. I love what they've done. And I think that that's supportive for the price of crude oil. As far as the bond market, there's just too much supply out there. And when there's a lot of supply, as the balance sheets roll off and QE comes to an end and the central bank put in Europe is not there anymore, it means that higher interest rates are going to be necessary for that paper to flow from central bank hands into individual holders' hands. Because individual holders are looking for a return. The central banks were just looking for stability. Stay tuned, folks. At the top of the hour, I'm going to be back with the Commodities Hour. So don't go nowhere. Get yourself a cold drink and join me for the next hour after these messages and some good songs, too. So stay right there. Andy Hecht signing off for the Tom O'Brien Show. See you soon.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com.
This is TFNN.